So let me introduce the topic now. Whenever you are a public company, you are required to prepare what we call published accounts for the members of the public. When you're a public company, you're supposed to prepare what we call published accounts. So what we want to discuss in this topic is, when you are preparing a complete set of financial statement as a company for publication purposes, what should you include in that complete set of financial statements? In other words, what are the components of a complete set of financial statements for publication purposes? Now, there are 5 components that should be included in any complete set of financial statements for publication purposes. So let me list them first. So one thing that you as a public company are required to include in your complete set of financial statements for publication purposes is what we call a statement of financial position. A statement of financial position. This is what you could also call balance sheet. It's also called balance sheet. So that's one of the statements or components that should be included. Number 2, you are required to include what we call statement of profit or loss and other comprehensive incomes. In simple, this is what you could also call income statement. You could find some books calling it income statement. So we are supposed to include a statement of profit or loss for the company and what we call other comprehensive incomes. We shall look at them later. That's number 2. Number 3, as a company, you are required to include also what we call statement of changes in equity. What were the changes in equity in your company during the year? So you prepare a statement showing the changes that took place in your company this year and which affects any component of equity. So you prepare what we call a statement of changes in equity. Number 4 component that you should include in your complete set of financial statement is what we call statement of cash flow. Statement of cash flow. That is also what you should include, statement of cash flows. Okay, so that's a normal, what you could also call cash flow statement or statement of cash flow, the same. That is another component you should include in your complete set of financial statements. Number 5, you are also required to include what we call explanatory notes. Explanatory notes and accounting policies. Maybe we could put it this way. Let me start with, you are supposed to include accounting policies. Maybe I could put it that way. Include accounting policies and explanatory notes. So those are the 5 components of a complete set of financial statement for publication purposes. It's also good to remember this list, because some questions I've asked you in the theory questions. State the components of a complete set of financial statements. We are saying they include 1, statement of financial position. Number 2, statement of profit or loss and other comprehensive income. Number 3, statement of changes in equity. Number 4, statement of cash flows. Number 5, accounting policies and explanatory notes. Okay, now we want to start with how to prepare. Listen to this now. How do you prepare the income statement? I'm starting with number 2. How do you prepare the income statement or statement of profit or loss for publication purposes? For publication purposes. The way you are preparing an income statement for financial reporting, for financial accounting, in your financial accounting or foundation level, or what you used to call section 1, the way you used to prepare the income statement is slightly different than the way you prepare it for publication purposes. In other words, how you prepare an income statement for internal reporting of your company is slightly different from how you prepare that income statement for publication purposes. So I want to explain the key issues that you should note when you are required to prepare an income statement for publication purposes. Okay, so let's start with the how to prepare a statement of profit or loss. Don't write for now. Statement of profit or loss or for publication purposes. I have said they are almost similar, or it's almost similar with the one for internal reporting. So let me be reminding you how you used to prepare it. Then I mentioned the key points. Obvious, you used to start with the sales. You have to quote whatever the sales for the company were, whatever the sales were. Then from there, you normally come and say less cost of sales. You less cost of sales. Now listen. In your financial accounting of the foundation level or section 1, you remember to get the cost of sales, you had to take the opening stock, add purchases, get what you used to call goods available for sale. Then you had to minus closing stock, whatever it is. Then you had to get the cost of sales. You had to push it to the extreme. And that means you got the sales compared with the cost of sales. You had to remember getting the GP or the gross profit. That's how you used to present the cost of sales calculation. You had to take the opening stock, add purchases, less closing stock, then you get the cost of sales. Now listen, when it comes to income statement for publication purposes, listen, the key point is this now. For publication purposes, you as a company, you are not required to show how you arrived at the cost of sales on the face of the income statement. Get the point there? That you are not supposed to show the workings of the cost of sales on the face of the income statement. The way you used to do it in financial accounting? No. Listen, so what you do as a company, do that calculation somewhere, get the cost of sales. The workings could be the same. Opening stock, add purchases, and any other item that your company normally charges to cost of sales. Once you get that figure as a working somewhere, you bring it as a single amount on the face of the income statement. On the face of the income statement. That is important. So you don't show the workings of the cost of sales on the face of the income statement. Do the workings for the cost of sales somewhere, then bring it as a single amount on the face of the income statement. Then once you do that, then you compare the sales with the cost of sales and you get what we call the normal gross profit. You minus, you get the gross profit. From there, you know that we always come and subtract expenses, electricity, water, telephone, insurance, and so on. That's what you used to do in financial accounting. You minus the expenses from the gross profit so that you arrive at what we call the net profit. Now listen, for publication purposes, listen now, for publication purposes, we are not required to show the expenses individually. In other words, don't come and say electricity, water, depreciation, telephone, postage, stationery, and so on. Don't list the expenses individually. Listen, don't list the expenses individually. Instead, those expenses that your company has incurred, they should be classified according to the function they perform in the organization. So you classify your expenses according to their function. One of the functions that may be performed in an organization is the administration function. So if you have incurred an expense which you as a company you think is of administration in nature, that expense, if it's of administration in nature, then get all those expenses. Again, listen, get all those expenses that are of administration in nature, combine them somewhere combine them somewhere as a working, and you bring them as a single amount. You bring them as a single amount under the name administration expenses or admin expenses or administration expenses. So you come and show them as a single amount. Get the total of all your admin expenses. Maybe it's electricity of the office. You know, we use the office for administration purposes. Maybe it's salary for the office workers. Maybe it's depreciation of office machines and so on. All those expenses that are related to administration of your company, combine them together, bring them as a single amount on the face of the income statement. Don't show them on the face. Don't come and tell us electricity of the office, insurance of the office, telephone of the office. Yes, it's true they are administration expenses, but you don't show them on the face of the income statement, but instead we are saying combine them somewhere, bring them as a single amount on the face of the income statement. Another function that may be performed in an organization is what we call the selling and distribution function. Selling and distribution function. Again, any expense that you as a company have incurred, which is of selling and distribution in nature, combine them again somewhere, bring them as a single amount on the face of the income statement. So for example, when you depreciate delivery van, we normally use delivery van for distribution. When you pay salary to the salesman, that is of course a selling and distribution expense. Advertising is an example of selling and distribution expense. Provision for bad debts, it comes because of selling. All those expenses that are related to selling and distribution of your goods, then again, don't show them individually on the face of the income statement. No. Combine them somewhere, bring them as a single amount on the face of the income statement and show it as a single amount by the name of selling and distribution expenses. Selling and distribution expenses, or some books will just call them distribution expenses. Good. Once you minus those expenses, get the net from the gross profit. You have minus the admin expenses. You have minus the selling and distribution expenses. Get what we normally call profit from operations. Get what we call profit from operations, whatever it is that you get as the net amount. Once you get the profit from operations, the next thing you come to is what we call finance cost. One example of finance cost, of course, everybody should be knowing by now. One example of finance cost is the interest expense. Interest expense, when you have a loan, you pay interest. When your company has issued some debentures, you pay interest on those debentures. Those are examples of finance cost. I'm not saying it's the only one, but the major example of finance cost is the interest expense. Whether it's interest on loan, whether it's interest on debenture, whatever interest you are paying. Okay? Whatever it is, you minus. Good. The other item after finance cost, you come to what we call investment income. Maybe your company has some investments. Maybe your company has some investments, and from those investments, they are earning some income. This could be in form of dividend received. Maybe you have shares in another company and you are earning some dividend. So bring that dividend received as an investment income. Or it could be you have put in some money in a fixed deposit, or maybe you have bought some treasury bonds and they are giving you interest as an income, not paying. They are giving you interest as an income. So another example of an investment income could be interest income. Interest income. Whatever it is, you add. That is an income you add. Then once you do that, get the net there, get the net there, and whatever you get, that is what we call profit before tax. That's what we call profit before tax. Then once you have that, you come to tax. Come to tax. Now listen, for some companies, there are various forms of taxes. One of them is what you could call the current tax. Whatever it is. In financial reporting, in financial accounting, some questions would call it corporation tax, whatever it is. But we also call it current tax. Okay? That's one form of taxation. The other form of tax is what we call deferred tax. Now, when it comes to deferred tax, sometimes you add, sometimes you deduct. Corporation tax, no, that current tax, it's a deduction. But when it comes to current tax, when it comes to deferred tax, there are times we shall be adding it, there are times we shall be deducting it. So if we shall be adding it, then we add it to the amount of the corporation tax or current tax. If we shall be deducting it, then you deduct it from the amount of the current tax so that you get what we call the net tax expense. You get what we call the net tax expense. Whatever it is, we push it to the extreme. You get the net tax expense. So whether to add the whether to add the deferred tax to the current tax or to minus, that is something we shall talk about later. But for now, I'm just trying to show the format of how to prepare an income statement for publication purposes. So those are some of the things we shall discuss later. How to know whether to add the deferred tax to the current tax or whether to deduct the deferred tax from the current tax. That is something we shall discuss later. Good. But once you adjust those two, that is the current tax and the deferred tax, get the net tax expense, you minus. Then you get what we call profit after tax. You get what we call profit after tax. Okay? Good. Once you get the profit after tax, now I want you to listen again. Now, when you are doing financial accounting in your foundation level or in your financial accounting of section 1, the time it used to be called section 1, listen, you did a topic called company accounts, and in that topic, you remember, once you got that profit after tax, you know you had to appropriate that profit. You had to do the appropriations of this profit. If you remember, you had to come and minus things like dividends, whatever it was. Okay? Then you had to have things like transfers to general reserves. Just reminding you, transfer to general reserve, for example. Then you remember, you used to get what you used to call retained profit for the year. This is what you used to call retained profit for the year. Okay? Then you also remember, you had to come and add what we called retained profit brought down by the beginning of this year. What was the retained profit brought down? You added it, you add. Then you remember, you used to get what we call retained profit carried down. Retained profit carried down. So that's how you did the appropriation of the profit after tax. That means you remember, you had to minus the dividends if your company paid dividends, if there was a transfer to a reserve, or they were creating whichever form of reserves, whatever it is, you had to minus. Then you had to get what you used to call retained profit for the year. Then you had to add what you used to call retained profit brought down, so that you get what we call retained profit carried down. Now listen to this now. Listen to this now. But when it comes to income statement for publication, listen, we do not, an important key point is here, we do not do the appropriation of this profit in the income statement. In other words, you don't appropriate that profit in the income statement like I've done. Yes, for internal reporting, then you could do it. But for publication purposes, the requirement is that you do not show the appropriations of the profit on the face of the income statement. Listen, all these appropriations will be done somewhere, and that is where we call the statement of changes in equity. It is there that you will appropriate the profit. with the same things: dividend, transfers to reserves, return brought down, return carried down. All that will go to what we are calling the statement of changes in equity. So in other words, I'm saying, listen to this now. In other words, I'm saying, once you got your profit after tax, when you are preparing income statement for publication purposes, once you get the profit after tax, then it means you are through. Listen, it means you are through with the income statement. It means you are through with the statement of profit or loss, or what you could call the income statement. That is the end. Listen, that is the end of the statement of profit or loss, or what you could simply call income statement. That means you don't show, that's important, you don't show the appropriations of the profit on the face of the income statement. Good. Now listen. But it also depends on the way the question is framed to you. If the examiner told you, or has told you, prepare a statement of profit or loss and, listen to this now, and other comprehensive income, and other comprehensive income, and other comprehensive income. That's what I want to talk about now. And other comprehensive income. Or sometimes they tell you prepare an income statement and other comprehensive incomes. Now listen. Once you got the profit after tax, once you get the profit after tax, then it is at this point now that you come and now show what we call other comprehensive income. Other comprehensive incomes. Listen. These are gains that your company could have made. Listen to this now. These are gains that your company could have made, but the rules of accounting don't allow you to take them to the profit or loss. Your company made a gain, but the rules of accounting for that gain don't require you to take it to the statement of profit or loss or to the P&L account. No. But again, so you are allowed now to show it as part of other comprehensive incomes. Let me give you an example. Assuming as a company you have an asset, let's call it land, which has a balance brought down of 100 million. During the year, you could have revalued that land. You could have revalued that land upwards by an extra 20 million. So it's obvious you must have debited land by 20 million, and it's obvious you must have credited an account called revaluation reserve account. Whenever you revalue a fixed asset, or what we can call an current asset, you debit the asset and you credit the revaluation reserve by that 20 million. Listen, that revaluation reserve, it's true, it's a gain. Or in other words, that 20 million is a gain. But the rule of accounting does not say that I debit the asset by 20 million and I also credit P&L account by 20. No. As much as it's true it's a gain, I don't take it to the P&L. Yet it's a gain. So that's why I'm saying that there are some gains your company could have made, but the rules of accounting don't allow you to take them to the profit or loss. Yet they are gains. So that's when now you come and show them under this section we are calling other comprehensive income. You show them under this section we are calling other comprehensive incomes. So one example of what we can classify as part of other comprehensive income could be the gain on revaluation. Gain on revaluation of fixed assets. Gain on revaluation of fixed assets. or what you can call non-current assets. Good. That's another one example. Let me just give you another example. There are many, but we shall be coming across them later. Okay. But let me give you another example. Now, if you are a company, listen, if you are a company which undertake foreign currency transactions, if you are a company that undertakes foreign currency transactions, maybe you normally buy goods on credit from other countries and so on, or you sell, or maybe you have a branch in other countries and so on. The point is, it means therefore, somewhere, someplace, you will be required to translate your currency or your figures from the local currency to foreign currency, or foreign currency to local currency. Okay? We are saying, if you are a company that undertakes foreign currency transactions, somewhere you will have to translate those foreign currency transactions into your local currency. For example, if you take a loan from a bank in America, for example, they will give you that loan in US dollars. Okay? Let's assume 1 million US dollars. You will not record it in your books at US dollars. You will record it in your books in Kenya shillings. Are you there? Good. So you will ask yourself, at the time I was given that loan, what was the exchange rate? Let me give you a simple illustration. You took a loan. So when you took that loan, if you took it in Kenya shilling, of course you went to a bank in Kenya, they give you a loan, you will debit bank and credit the loan account. You will debit bank and credit the loan account. Okay? Listen. So assuming you went to a US company, bank, and they gave you a loan of, let's say, $100,000. At a time when $1 US was equivalent to 100 shillings, Kenya shillings. So you will record your loan in Kenya shillings, which is about how much? If $1 US is equivalent to 100 shillings at that time, and you took a loan of $100,000, then it means you took a loan of 10 million Kenya shillings. So you will debit bank account in your books and you'll credit the loan account by 10 million. Now listen. By the end of the year, let us assume you have not even repaid the loan. It's still $100,000. I'm assuming you have not repaid the loan. Which means you will have to come and say your balance carry down at the end of the year. And you are carrying down, listen, you are still carrying down a loan of $100,000. But you're not going to carry down at $100,000. No, at 10 million, Kenya shillings. No. You will need to ask yourself, listen, if I am to repay this loan by the end of the year, if I am to repay it, how many Kenya shillings will I need to repay the $100,000? The loan has not changed, still $100,000. But if I am to raise $100,000, how many Kenya shillings do I need? Suppose at the end of the year, listen, suppose at the end of the year, $1 US is equivalent to 95 Kenya shillings. So you are going to carry down a loan of $100,000, but you're not going to carry it down in dollars. You're going to carry it down in shillings. Therefore, if at the end of the year the dollar is equivalent to 95 Kenya shillings, then it means you will need 9.5 million shillings. You will need 9.5 million shillings to raise your $100,000. Are you there? Good. Now listen. If you look at this account, your loan by the beginning of the year was $10 million, 10 million Kenya shillings. But now it's like you're carrying down 9.5. It looks like you have repaid your loan. But have you repaid your loan? The answer is no. But the loan has gone down. So it looks like you have repaid by a loan by 500,000, but you have not repaid. That 500,000 came because of the differences or the fluctuations in the exchange rate. That to you is a gain. That to you is a gain. What if by the end of the year, 1 Kenya shilling was equivalent to 105 Kenya shillings? You will have carried down your loan by how much? You will ask yourself, for me to raise $100,000, how many Kenya shillings do I need? If at the end of the year, 1 Kenya shilling is equivalent to $1 is equivalent to 105 Kenya shillings, then it means my $100,000 is worth 10,500,000. So I'm going to carry down my loan account by 10,500. Listen, but when you look at this account, it's like you have been given an additional loan. You began with the year with a loan of 10 million, but now you're carrying down a loan of 10.5 million. It's like you have been given an additional loan of 500, which the difference is on the credit. But is it a loan you have been given? No. It is just because of the changes in the fluctuations, or because of fluctuations in the exchange rates. Of course, now, as a company, you are losing because you are going to pay more just because of the fluctuations. This time you are going to pay with an extra 500 just because of the fluctuations. If the dollar was equivalent to 95 Kenya shilling, then you are going to pay less. Then you made a gain. Now listen. So that 500, which is a gain or loss, there are some scenarios, listen, there are some scenarios whereby the exchange difference, we call it the exchange difference, that 500, we call it the exchange difference. That exchange difference is a gain or it may be a loss. There are some of them, the rule requires, listen, there are some of the exchange differences whose rule require you take the gain to the P&L or profit and loss. There are some rules or some exchange differences where the rule for them does not require you to take it to the P&L account. Yet, it's a gain. I'm not saying this one, and I'm only giving you an illustration to show that sometimes you may be gaining or losing whenever you have transacted in a foreign currency transaction. So you either gain or you may either lose. But that 500, I'm not saying this one, you take it to the P&L account. I'm saying there are some exchange differences where the rule for it says take it to the P&L account. There are some other exchange differences whose rules require you don't take it to the P&L account. So we are now assuming that you have an idea of what other example. So if, listen to this now, if your company has an exchange difference whose rules don't require you to take that gain to the income statement, yet it's a gain, but the rule does not require me to take it to the P&L account, then I'm required to show it under other comprehensive income. So maybe I can list another example here, is what we are calling exchange difference. Exchange difference on translation. Exchange difference on translation. On translation of foreign currency transactions. Foreign currency transactions. That's another example of other comprehensive incomes. For now, let me assume those are the only ones. Then you come and get, listen, for now I'm assuming those are the only ones. Get your profit after tax plus all these other comprehensive incomes, whatever the question will allow you. Then get the total down there. And that total is what you call total comprehensive income. Total comprehensive income. That's how, in general, that's how, in summary, maybe I can put it that way, that's how, in summary, you prepare an income statement for publication purposes. Let me review it once more very fast now. I've said you have to start with the sales. That's obvious. Then I've said, come to cost of sales. The key point I've mentioned there is, the key point we have mentioned there is what? Is that you don't disclose. We have said you don't disclose the figure for the cost of sales working on the face of the income statement. Don't show the cost of sales working on the face of the income statement. Okay? We have said, do that calculation somewhere, bring it as a single amount on the face of the income statement. Then do that, then you minus, get the gross profit. Then I said, you minus the expenses. But I've said, those expenses should be classified according to their function, either administration expenses or selling and distribution expenses. Then I've said, do the calculation or the totaling of them somewhere. All your admin expenses, get them somewhere as a working, bring them as a single amount. Do the same for selling and distribution expenses, get their total elsewhere, bring them here as a single amount. You minus. Then I said you get what we called profit from operations. Then you minus what we call finance cost. I've given an example, one example of finance cost. There are others we shall discuss later. But one example of finance cost we have said is the interest expense. Then we have said once you minus the interest expense or the finance cost, you come and get or you add any investment income, whether it's in form of dividend received or in form of interest income, whichever it is. Good. Then after you've done that, get what we call profit before tax. Then I've said you come now to tax. There are various types of taxes. One form of tax could be current tax. The other one could be form of deferred tax. Get the net of the two. Get the net of the two, whichever the net, call it tax expense, and you minus on the extreme. I've said current tax is always deducted. It's an expense. Corporation tax, or what you can call current tax. Deferred tax, I said, there are times we shall be adding, there are times we shall be deducting. How to know which one to add, which one to subtract, that is something we can discuss later. But get the net of those two forms of taxes, then you get what we are calling the tax expense. Then you get the figure we have called profit after tax. Then I've mentioned a key point there. We have said you are not required. You are not required to show the appropriation of that profit on the face of the income statement the way you used to do it in financial accounting. I said all the appropriations will be done elsewhere on the statement of changes in equity. Then I've gone further and said, if the question, listen, I said, if the question told you, number A, prepare an income statement, then you stop after getting the profit after tax. If the question said, prepare an income statement and other comprehensive income, or what they could call statement of profit or loss and other comprehensive income, then now you show the other comprehensive incomes as per the question. I've only given two examples. One could be the gain on revaluation of fixed asset. Of course, listen, if it's a loss, you minus. If it's a loss on revaluation, you minus. Then I've given another example, exchange difference on translation of foreign currency transactions, whatever it is. Again, it could be a gain or loss. If it's a gain, you add. If it's a loss, you minus. Then I've said you get what we are calling total comprehensive incomes. Okay, good. I want to believe we are together so far. I want to believe we are together so far. If we are together so far, maybe you can chat and say yes. I want to know whether we are together so far. Chat and say yes before I proceed. I want to know we are together so far. You chat there and say yes. I will see it on my screen. Yes, good. If we are together so far, fine. Now, good. Thank you. We are. Now, maybe before we continue, let me mention one or two things. There are some of you who have joined us for this class. Listen. And for also those students of ours who are continuing with the class. Now listen. I want you to tell your friends that we are offering online classes, and we are offering online classes for financial reporting like the one we are doing now. Tell your friends we are also offering online classes for financial management. That is financial management of the intermediate level. Tell your friends we are also offering online classes for advanced financial reporting of the advanced level. Tell your friends that we are also offering financial accounting of the foundation level and that of ATD1 and ATD2. In ATD1 there is financial accounting. In ATD2 there is also financial accounting. So tell your friends that we are offering online classes, those 4 subjects. 1 is the financial reporting of the intermediate level. 2, financial management of financial management of the intermediate level. 3, advanced financial reporting of the advanced level. 4, financial accounting of the foundation level, and the one of ATD1 and ATD2. Good. Now, if your friends cannot attend live classes, if they are not able to attend live class, you can tell them that they can still buy what we call the pre-recorded videos. They can still buy the pre-recorded videos, and then they can watch the videos at their own free time, at their own pace. Whenever they have a question, they call me anytime. We shall assist. Okay? If they are not able to join live classes, then they can buy the pre-recorded videos. Okay? Tell them that they can reach me on this number, 0722 65 8875. 0722 65 8875. That is my number, 0722 65 8875. If you're using the country code, it's 254 722 65 8875. Okay, those are the subjects we are offering online classes, either live class or you can buy the pre-recorded videos. Good. Now, if you're watching through YouTube, you can subscribe. Please click that subscription button down there. If you're watching through YouTube, click that subscription button and subscribe to my YouTube channel so that you can be notified whenever we post new videos into the YouTube. If you're watching through YouTube, please click that subscription button so that you can be notified whenever we post new videos into the YouTube. For the name of the channel, it's called CPA Joseph Njuguna. That is the name of the channel, CPA Joseph Njuguna. You can click it and you can go to the YouTube, go to YouTube, search CPA Joseph Njuguna. You will see that YouTube channel. Click it, then subscribe. Okay? Maybe the last thing is, I want to believe at least by now, you have managed to get something even before we put down the summary notes. Okay? So if you are okay, at least you have managed to get something so far. Click that like button down there. If you're watching through YouTube again, click that like button, subscribe, to like the video. You can even put down a comment. I want to believe by now at least you have understood something before we continue. So click that like button, like the YouTube channel, to like the video, and also maybe put down a comment. I hope you have got something so far. Now, that's all I wanted to mention about our online classes that are still going on currently, those 4 subjects. Good. Now, before we develop the topic, let's put down the summary note on what we have already said so far. Before I develop the topic, we are not yet through with the income statement. There are some more details I want to mention about how to prepare income statement for publication. We are not through yet, but let's put down the format and something small on the topic, on what we have said so far. So put down the topic, published accounts. Put down the topic, published accounts. Put down the topic, published accounts. And you see this. The following are the components. The following are the components to be included. Following are the components to be included. The following are the components to be included in a complete set of financial statements. The following are the components to be included in a complete set of financial statements for publication purposes. The following are the components to be included in a complete set of financial statements for publication purposes. For publication purposes. Number one. Statement of financial position. Statement of financial position. 2. Statement of profit or loss. Statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. Number 3. Statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Number 4. Statement of cash flows. Statement of cash flows. Statement of cash flows. Number 5. Accounting policies and explanatory notes. Accounting policies and explanatory. Accounting policies and explanatory notes. Accounting policies and explanatory notes. Okay. Then we can copy this format. I don't need to change anything. I don't need to change anything so far. I don't need to change anything. So maybe we can still copy the statement of profit or loss and other comprehensive income. Let's put down this format. Let's put down this format. You write that subheading, statement of profit or loss and other comprehensive incomes. And other, sorry, the word other is missing. And other comprehensive income. Statement of profit or loss and other. Let me put it clear here. Statement of profit or loss and other comprehensive incomes. Okay. Then we can now copy the format where we have said you start with the sales. You start with the sales. Then you come to cost of sales. You less cost of sales. Get the gross profit. Then you come to administration expenses. Administration expenses. Then you come to selling and distribution expenses. Minus those two. Then you get what we call profit from operations. Get what we call profit from operations. Then you come to the next item called finance cost. Finance cost. I've put in bracket interest expense. You can see I've not closed that bracket. For the finance cost, I've not closed the bracket. I've left it pending because there is something there we shall add. I've only given one example for finance cost, interest expense, but there's another one we shall discuss there. But whichever we shall minus, we shall get, we minus. Okay. Then you come to the next item called investment income. Investment income. I've put in bracket whether in form of dividend received or interest income. Dividend received or interest income. That one you are adding. That one you are adding. Then you get what we call the net is what we have called profit before tax. Get the net called profit before tax. Then you come and minus the tax. Tax, we have said there are two categories there. One is current tax. I've put it on the inner column. I've put it on the inner column. Then for deferred tax, I am saying this stroke, this, meaning you can either add or minus for deferred tax. And we are adding or minusing from the current tax. Then you get the net, push it to the extreme, and then you deduct that net amount from the profit before tax, you minus it. Then you get the profit after tax. Then you get the profit after tax. Okay? Assuming you're through. Assuming you're through now. Once you get the profit after tax, now you go to the section we are called other comprehensive incomes. Now go to the section called other comprehensive incomes. You can copy, there is no need to change anything. There is no need to change anything. We have given two examples of other comprehensive incomes, one of them being gain on revaluation of fixed assets. That's one. Next one was exchange difference on translation. Exchange difference on translation of foreign currency transactions. Exchange difference on translation of foreign currency transactions. Okay? Good. I think now we are okay. Then you get the total of all that and you call it total comprehensive income. You call it total comprehensive income. Total comprehensive income. Okay, so once you're through with the copying, we can continue now. Once you're through with the copying, you can continue now. If you're through, you can write there done, so that I know you are through with the copying. You write down, I'll see. Whoever is through can write down. So that we can now, good. Thank you. Let's now continue. I want to develop the topic now. Good. Okay. Now, let me take you back. Let me take you back. Thank you. We want to discuss this thing I've called interest income or interest expense, sorry. I want to discuss it by asking you a few questions. I want to discuss it by asking you a few questions. This is something you must have done in your financial accounting. Don't try this. Don't try this. I want to use it to ask you a few questions. In your financial accounting, you did a topic called company accounts. And in that topic, you used to be given a trial balance. And in that trial balance, you could have been given something like 10% debentures, assuming to 500. Then in that same trial balance, the examiner gave you interest on debentures, maybe 40,000. I'm assuming. I'm only showing a section of the trial balance. Okay? Then from there now, listen, the examiner could ask you to prepare an income statement. Now, the question is this now. Whenever you are given a trial balance of this nature, and the examiner used to ask you to prepare an income statement of profit or loss, whatever he called it, my question is, how much were you taking to the P&L account as interest? How much were you charging to the P&L account as interest? So look at this illustration and give me what you think should be the charge for the year for interest. When you are preparing the income statement for this company, how much would you charge as interest? Somebody has said 50. Joanna has said 50. Mutua says 50. Somebody else, one more comment before we discuss it. David says 50. Good. Okay. That's correct. That's correct. That's correct. I don't know. Let me, okay, here you have put 50. My question number 2. In the same case of this trial balance, were you taking anything to the balance sheet for interest? Were you taking anything to the balance sheet for interest as far as this trial balance is concerned? And if so, how much? Were you taking anything to the balance sheet for interest? And if so, how much? David says yes. So David will tell us how much. David says yes. Good. Joshua says current liability of 10,000. That's very good. Good. This time you have managed. Good. Thank you. Now listen. Good. This time my work is easier. I've asked this question before to find some students struggling to give you the amount to go to the income statement. But I just want to mention this because most of you have got it. They have answered all my questions right. Now listen. Whenever you are preparing an income statement or what we are calling profit and loss, we normally follow a concept called accrual concept. You know that concept. That concept states that you as a company, you should recognize costs when they are incurred. You should recognize costs when they are incurred, but not when money is paid. You recognize costs when you're doing the income statement of your company for a particular year. You recognize in that year, you recognize the cost that was incurred, irrespective of whether it has been paid or not. That's what we are calling the accrual concept. That costs are recognized when they are incurred, but not when money is paid. Listen. So if you look at this trial balance, this company has a 10% debenture. So it means every year they are supposed to repay the debenture with an interest of 10%. 10% of 500,000 is 50,000. That means that's what they're supposed to be paying every year as interest. Listen. So whether they have paid it or not, that is not the concern of the income statement. Sorry, that's not the concern of the income statement. Whether they have paid the 50 or not, that's not the concern of the income statement. The income statement says, prepare me on accrual basis. You recognize costs when they are incurred. So this year we have incurred a cost of 50. So whether we have paid it or not, we should recognize that 50 in the income statement. Okay, now listen. It is that time when you are preparing the balance sheet, that's when you will bother yourself as a company to ask yourself this question. I'm supposed to have paid my debenture holders 50. Have I paid them 50? It's that time that you go back to your trial balance and you realize that according to this trial balance, you have only paid them 40 as interest on debenture. It means, therefore, there is another balance of 10 which you have not paid. And it's that 10 that you as a company, you will take it to your balance sheet as a current liability. Among your current liability, there you will have interest owing of 10,000. Okay? That's one scenario. Let me give you another one. In the same financial accounting, sometimes the examiner could give you this trial balance. Gives you 10% debentures, 500. And in that trial balance, there is nothing like interest. Question is, when you are preparing the income statement or the profit and loss account for this company, will you still charge interest? You are given a trial balance of that nature, 10% debentures amounting to 500, and then you are told to prepare an income statement for this company. Will you still charge interest? Yes or no? In the income statement, will you still charge interest? Joanne says yes. Okay. Yes. 50,000. Already I've explained the concept. So already I've explained the concept. The concept is what? The accrual concept. So whether you have paid it or not, that must be charged. So you'll come and still charge how much? Interest of 50, which is 10% of 500. Listen. Then again, when you are preparing the balance sheet of this company, that's when you get bothered to ask yourself, do I owe my debenture holders anything? According to this trial balance, it's like I've paid them nothing. So it means, therefore, that the whole 50,000, which was the charge for the year, I've paid them nothing out of it. So the whole amount also becomes the liability for the year. Also becomes the liability for the year. So in your balance sheet, again, among your current liabilities, there you will now have, again, interest owing of 50,000. Now listen, I want to change something in the first case. Suppose in the trial balance, I'm changing something. Suppose in the trial balance, instead of 40, you are given 50. Listen. In the income statement, you will still charge 50. You will still charge 50, which is 10% of 500. Then, when you'll be preparing the balance sheet, you will ask yourself, do I owe my debenture holders anything? That's when you go back to the same trial balance and you realize you have paid them 50. So automatically, it means you owe them nothing. Because the charge for the year is 50. According to the trial balance, you have paid 50. So you owe them nothing. So you take to the balance sheet nothing. Now listen. Rarely will the examiner give you this kind of a trial balance. Because even if you guess and you took 50 to the income statement, you will get it. If you forgot to take anything to the balance sheet, you will still get it. So rarely will the examiner gives you this kind of a scenario. But the examiner will always give you a scenario where part of the interest is paid, like that 40,000, or he will give you a scenario where no interest is paid. Listen, I brought this because we are still doing company accounts in published accounts. So in all your past papers, the examiner has always tested this in the trial balance that will be given. It will be given as a trial balance where you have a case 1. They may not call it a 10% debenture. They might call it a 10% loan. They might call it a 10% bond. The concept is the same. It's a long-term liability. Okay? Whether they are calling it debenture, whether they are calling it loan, whether they are calling it a 10% bond, the concept is the same for interest on that loan, or for interest on that debenture, or for interest on that bond. The concept remains the same. So even at this level where we are doing financial reporting, whenever you are given a question on published accounts, you will always be tested as either a case 1 scenario where part of the interest is paid, or the examiner will test you on the second scenario where no interest was paid. Okay? So I want us to put down a summary note just to remind you when you are revising concerning the treatment of interest and debenture. So have another subheading, call it treatment. Call it treatment of interest, treatment of debenture interest. Call it debenture interest, treatment of debenture interest. Then under that, we want to put down the summary note in form of an illustration. Call it case 1. Call this one case 1, where part of the interest is paid. Call it that way, where part of the interest is paid. Where part of the interest is paid. Then you can copy this illustration. I don't need to do another illustration. Show like you're preparing a trial balance. Then in that trial balance, there's a 10% debenture amounting to 500. Then there is interest on debenture amounting to 40,000. Then you show like you're closing your trial balance. Then below that, you show a section of the P&L, what you could call the income statement section, the P&L. There we have charged interest of 50. You may want to remind yourself, how did we get that 50? We took 10% of the 500,000. Why did we take 10% of 500,000? Because the rule says you prepare your financial statements on accrual basis. You recognize costs when they are incurred, but not when money is paid. So in the income statement, you will have that 50, 10% of 500. Then below that, show like you are preparing a section of the balance sheet, what you could call statement of financial position. And among the current liabilities, you show interest owing at 10,000. Why? Because you have paid 40 and you're supposed to have paid 50. You have only paid 40. So there is a liability that you owe the debenture holders for their interest amounting to 10,000. Good. Finish that case 1. Want to write something about case 2 now. Want to write something concerning case 2. That's case 1. I hope you are through. Whoever is through can write down again so that we move on. Whoever is through can write it down. Good. So we can now move on. At least somebody has finished. Good. Thank you. Now let's go to case 2. So show again like you are preparing a trial balance. But before you prepare it, come and call it case 2. Call it case 2, where no interest is paid. Where no interest is paid. Where no interest is paid. Show it as a case 2, where no interest is paid. Then copy that again. Copy that again. Show like you're preparing a trial balance. That trial balance, we have a 10% debenture amounting to 500. Then you show like you're closing that trial balance. Then show like you're preparing a P&L, a section of it. That is P&L. And you charge interest of 50. You charge interest of 50. And again, below that, you show like you are preparing the P&L balance sheet, And among the current liabilities, we have said, you have a debenture interest owing, or just interest owing of 50. You have debenture interest owing of 50. So finish if you're through. Somebody has already said done. So let me develop the topic now. This is another concept we want to talk about now. Okay. So let's discuss another concept now. Let me explain another concept. Let me explain a key concept as far as we are still discussing some other issues concerning income statement. We are not through yet with our discussion concerning how to prepare income statement for publication. Now listen, as a company, you can raise finances by issuing preference shares. You either issue ordinary shares, you either issue bonds, or you issue debentures, or you can issue preference shares when you are raising finances. Now, when you are issuing preference shares, we have two types of preference shares that you can issue. You can issue what we call a redeemable preference share, or your company can issue a non-redeemable preference share. Let us assume company A, when they were trying to raise finances, they issued a 10% redeemable preference shares amounting to 30 million. Company B, this is A. Company B also wanted to raise finances, but then they decided to issue a 10% non-redeemable preference shares amounting to 30 million. So both companies raised 30 million. Now, my question to you is this. When these two companies are preparing their balance sheet, first I want to believe you know the difference between a redeemable and a non-redeemable preference share. Those are not new terms to you. You have heard them before. And even the term itself is already telling you redeemable, non-redeemable. The terms are already saying. So my question is, when you are preparing in your financial accounting, when you are preparing the balance sheet of this company, were you putting the 30 million on the same place? Yeah, that means for company A, will their redeemable preference share appear in the same place where the balance sheet, the non-redeemable preference share of company B will be? In other words, will you put these two types of preference share in the balance sheet same place? Do they normally appear in the same place in the balance sheet? When you are preparing the balance sheet of this company, do you put them under the same place? Of course, each company will have their own balance sheet, but what I'm asking is, if it's like assets, will you put them both under fixed assets or current assets? That's what I'm asking. I'm not saying they're assets. They're not assets, obvious. But where you normally put redeemable preference share in a balance sheet, is it the same place you will put the non-redeemable preference share? Yes or no? Joan says no. Joan says no. When you are preparing the balance sheet of company A and when you are preparing the balance sheet of company B, will you put the 30 million in the same place? Joan says no. Thank you. Thank you, Mutua. Yeah. Now let me explain. I think today people are getting the points. They're getting the things now. Now, company A, listen, company A, 10 years ago, they wanted to raise finances. So they issued a redeemable preference share. When they were issuing that preference share 10 years ago, they were telling the shareholders that time, or the providers of capital that time, one time in the future, we shall redeem these preference shares. In other words, we shall buy them back. We shall pay you your 30, you bring back our share certificates. That's what I was telling them 10 years ago. Meaning, that company A, 10 years ago when they were issuing the redeemable preference share, that company knew a time will come when we shall pay back the 30. Company B, when they were issuing the 10% non-redeemable preference share, 10 years ago still, that company does not have or did not have any obligation to buy back. It's non-redeemable. They don't have any obligation to pay back. Okay? So non-redeemable preference shares, the companies normally don't have an obligation to pay back. But if your company issued a redeemable preference share, then your company has an obligation to pay back. So company A, we say it has an obligation to pay back the 30 million. Listen, just like company A could have issued a 10% debenture. Whenever a company issues debentures or bonds, they normally have an obligation to pay back that debenture. When they were raising finances, they issued debentures, so they have an obligation. Listen, so they will normally take that debenture to the balance sheet. They would normally take that debenture to the balance sheet among the non-current liabilities. So among the non-current liabilities there, the company will have a 10% debenture. whatever the amount. Why? Because they have an obligation to pay back. Listen, the same way this company A issued a redeemable preference share, then it also means it has an obligation to pay back. So to company A, these preference shares are not part of capital. They are liabilities to the company. They are liabilities to the company. This company A has a liability to pay back the 30 million. When you are preparing the balance sheet of company A, you don't take 30 million of their preference share as part of capital. No, you take it to the balance sheet as a long-term liability. So among the debentures, you will have their 10% redeemable preference share. Redeemable preference share. It's a long-term liability because you as a company, you have an obligation to pay back. Now, for company B, when they issued a non-redeemable preference share, they did not have an obligation to pay back. So for them, that 30 million, they will treat it as part of capital, or in other words, as part of equity. Meaning, where you as company B, you show your ordinary share capital in the balance sheet, reserves, share premium, revaluation reserve, it is among those ones that you now put in your non-redeemable preference share, your non-redeemable preference share. Okay? I want to believe that you have got the difference on how to treat these two in the balance sheet. How do they affect the balance sheet? The redeemable, I've said, is a long-term liability. Why is it a liability? Because you as company A, you have an obligation to pay back that 30 million. For company B, they have no obligation to pay back the 30 million, but they will treat their preference share as part of equity. Good. That's one key difference. Number two, both companies issued a 10% preference. 10% preference. Listen. Meaning now, each of them, every year they are required to pay dividends at 10% of 30 million, which will come to 3 million. So company A is required to pay 3 million as dividend. Company B also is also required to pay dividend of 3 million. 10% of 30 million is 3 million. Now listen. The question again is this. These two companies, will they treat their dividend the same way? Will they treat their dividend the same way? The answer is no. Listen, the answer is no. For company A, don't forget, them it's a liability. They have an obligation to pay back the 30 million. And they took their 30 million to the balance sheet as a long-term liability, together with the debentures. And you know, interest on debenture is an example of a finance cost. Is an example of a finance cost. That's what I gave you here. Interest on debenture, we say it is an example of a finance cost here. Now, your company, listen to this now. If your company issued a redeemable preference share, they were borrowing. They were not raising finance, or they were not raising capital not to repay. They were borrowing to repay. So it means, therefore, listen, the cost of borrowing, when it is debenture, the cost of borrowing is interest. When it is preference share, the cost of borrowing through preference share is preference dividend. Listen, therefore, the preference dividend that you paid on the redeemable preference share, that should be considered as another example of a finance cost. Preference dividend on redeemable preference share should be considered as a finance cost. Why? Because you borrowed. That means the cost of seeking for those finances is the dividend you are paying. Okay? Now, Company B issued a 10% non-redeemable preference share. They will still pay dividend of 3 million. But for them, listen to this now, them, their dividend is not a finance cost. No, for them, dividend becomes an appropriation of profit. Where you got the profit before tax, if you are doing financial accounting in section 1, you are saying profit after tax, you less dividends, transfers to reserves, and so on. That's where the dividend of the preference would come in for the non-redeemable. That 3 million for Company B becomes an appropriation of profit. Important to know that. The dividend of Company A is not an appropriation of profit. The dividend of Company A is a finance cost because Company A borrowed finances by issuing redeemable preference shares. Okay? Good. But then, because they will be required to pay dividend, that dividend for them is not an appropriation of their profit, becomes a finance cost to them. It's a cost of borrowing. That becomes a finance cost. So, together with the interest on debenture, you could also have what we are calling preference dividend as another example of a finance cost. But which kind of preference shares? Said only on the redeemable preference shares. Good. Otherwise, for Company B, where they issued an unredeemable, their dividend becomes an appropriation of profit. For publication companies, it becomes an appropriation of profit in the statement of changes in equity. Okay? Where we said all the appropriations will be done, now is in the statement of changes in equity. Good. So what I want you to do, go back to your format that we had to draw, then you add as another example of finance cost, you come and say there plus preference dividend. Just to remind you that we are treating preference dividend as part of finance cost. And not all types of dividend, only on redeemable preference shares. Good. Now, we have no time to put down the summary notes on this. Preference shares and preference dividends. We shall put down the summary notes next time. That's when I'll give the summary notes next time for this. That's what I'll do. Give notes next time on these preference shares and preference dividend. So today I want us to stop there. Pick it up from there next time, where we shall discuss now. Put down the summary notes first. That's what I'll do next time. Put down the summary notes for preference shares and preference dividends. Then I'll still develop the topic. We are not through yet with the income statement. I'll talk about next time also what is this thing called deferred tax, and how do you know whether to add to the current tax or to minus from the current tax. And that's what we shall talk about also next time. We shall finish the income statement. We are not through yet. That's what we shall do next time. So allow me to stop there. But we have already mentioned that please tell your friends, or even if some of you are here and they have not joined our classes, we are saying, remember we are offering online classes. Those 4 subjects. 1, we have said, is financial reporting, the intermediate level, financial management of the intermediate level, advanced financial reporting of the advanced level, and financial accounting of foundation level, and the one of ATD1 and ATD2. Then I said, tell your friends that if they are not able to join the live class, they can still buy the pre-recorded videos, where they can watch the videos at their own free time, their own pace. And whenever they have a question, You can call me anytime. Good. Then I've said, to reach me, you can call me on this number 0722-658875. That's what we're saying. Then I said, if you're watching through YouTube, please go to that YouTube channel, click the subscription button to subscribe so that you may be notified whenever we post new videos into the YouTube for promotion. Okay. Then I said my YouTube channel is called CPA Joseph Njuguna. Then I said click the like button. Hope you have managed to get something. For those who are watching through YouTube, managed to get something. Click the like button for the video and even put down a comment if you have understood. Otherwise, thank you very much. See you next time. Unless there is a question for now, see you next time.